Hi, my name's Phil. I like talking about politics, and in this video I'd like to discuss the mortgage crisis as everyone prepares for the Bank of England to vote on interest rates again. People are expecting another increase and that it will not be the last. I want to discuss, not for the first time, just how insane the situation is. But first, if you'd like to be notified of daily news and politics, please subscribe to the channel. So I think the three main things to note as background for any current discussion on Bank of England interest rates. The first is that raising interest rates works to tackle inflation if high inflation is stoked by excessive demand. The whole point of the Bank of England raising interest rates is to deliberately reduce people's spending power. That's not a side effect of what it does. That is actually the whole point. When the Bank of England votes to raise interest rates, what they are doing is they are actively wanting people to spend less. They're saying that people are spending too much, need to spend less. And they say as much in their reasoning. The second thing to note, however, is that our high inflation at the moment is not caused by excessive demand. So it's not being caused by people spending too much, borrowing too much to spend even more. It's been caused by low supply, particularly of things like food and energy. Raising interest rates doesn't really work as an effective way of tackling low supply of things we need, like food and energy. What the Bank of England is trying to do is it's trying to get people to spend less on things which aren't stoking inflation, because it would be absolute madness for the Bank of England to say we are trying to stop people spending on food and energy. So what they must be doing is trying to get us to spend less on things that aren't stoking inflation in order to drive the prices of those down and lower inflation that way, while still seeing and living with high inflation in things like food and energy, where the consumption can only go down so much before people suffer. What we should be doing is dealing with the supply issues. But the Bank of England has no tools for that. It can't deal with those issues because you need economic policy for that. You need the government to either increase supply or apply price caps of some sort, and you need to do that via policy. Third thing to note is that raising interest rates like this can trigger a recession, and that's what a lot of people are fearing at the moment. It does this in several ways. The most direct way is because people are now spending more on their mortgage repayments, they're cutting back on other things. Well, the goods and services they're cutting back on are not now going to be bought. So the businesses providing those goods and services makes less money, meaning our GDP shrinks. And if it does that over a couple of quarters, you're in recession. But it could also just be people saving more money. Like if you imagine, let's say you're on a fixed rate now. You're still on your fixed rate. You've had your fixed rate for a few years. But it's going to come to an end, maybe in the next few months, maybe next year. And you're looking at all the news about the mortgage time bomb, the crisis. And you have a little look up. So what are my repayments likely to be when this fixed rate comes to an end? And you're looking at it's quite eye-watering. So there's a good chance what you do, instead of waiting for it to happen and then trying to work out where you're going to get the money from, you start saving now to buy yourself some time, take the edge off it in the hope that a year or two down the line, either your income significantly increases or the interest rates fall off. But the effect is the same. It doesn't matter whether people are giving banks more money in mortgage repayments or just depositing more money in their savings account. It's money not being spent on anything which sustains our businesses, drives GDP growth. It's money being taken out of this system effectively one way or another and resulting in lower profits, job losses and a shrinking economy. And I was just commenting on Twitter today that in the wake of the global banking crash 15 years ago-ish, Iceland prosecuted and imprisoned a number of bankers who recklessly triggered the crash. We didn't. We took a knighthood off one of them. Now, if we had prosecuted, Rishi Sunak may have found himself in a spot of bother because he was part of, it's not just that he was a banker at the time, he was specifically part of a group who triggered the crash in the UK. Instead of prosecuting him, we decided to put him in charge of the economy and then the whole government. Well, how's that working out? If putting someone in charge of the economy who caused the last financial crash results in us suffering the next one, we will only have ourselves to blame. There's also a tug of war over who is to blame for the current mess. See, the governor of the Bank of England, Andrew Bailey, has had to admit that the bank's forecasting model has been, to use a technical term, a load of bollocks. Tories are seizing on this to try and absolve themselves of blame by dumping responsibility on the bank. And although it is true to say, of course, if the bank has failed to accurately forecast the impact of inflation, they need to take responsibility for that. Its measures will have been suspect, for example. We have to remember that the type of inflation we have right now, supply side, needs economic policy, not monetary policy. So even if the bank had better models for forecasting, the government's failure to address problems with food and energy, say, would still be keeping inflation high. After all, what would the bank have done differently? Raise interest rates higher more quickly? That would have just brought the recession forwards. Maybe that's what the government wants. But it would seem a better strategy to me to avoid the recession altogether. In terms of the ordinary people caught up in this abdication of responsibility from the government and impotence from the Bank of England, because remember, they can't actually really deal with this, we now have the following problems. Mortgage holders coming to the end of their fixed rate terms are going to find themselves hundreds of pounds a month worse off in a cost of living crisis, which has already been raging for quite a while now. Businesses are going to struggle because people will spend less on their goods and services because they need more money to be able to keep a roof over their heads. This means less money earned and job losses. Those who are already managing restricted budgets but will now face higher mortgage or rent payments will end up having to cut back on things they really shouldn't be cutting back on. And what is that? That means more people being moved into real poverty. And how much worse it gets depends on effectively a competition. There's a competition going on between the Bank of England and the market, investors. The market is betting heavily in favour of interest rate rises this week. Now, the bank could say the market is making borrowing too expensive. It's sort of done it before. It could say, oh, you think we're going to raise interest rates? No, caught you out. We're not going to raise them at all. They could vote against another interest rate rise this week because they may think that the market is driving up the cost of borrowing too high. The decision will be influenced, of course, by the inflation figures being published tomorrow as well. They're more likely, I suppose, to vote against another rate rise if the inflation figures look better. But in general, the bank won't want to raise interest rates because that works to shrink the economy and public spending. Obviously, the higher the interest rates, the lower the tax revenues. But also, a smaller share of the tax revenues are available to be spent on public services because we're having to spend more servicing the national debt. It's basically a game of poker between the bank and investors. The bank's twin aims are to retain market confidence and persuade people to massively cut down on their spending. Now, if the inflation figures and other indicators suggest to them that they can do this without increasing it more, then they won't do. And as I say, they would like to do this in a way that doesn't cause economic damage. But it is clear from what they say and what the government have been saying that it is not a priority. The question really, I suppose, is for how much longer are the Bank of England going to be playing this game? Because inflation is far too high, but food and energy prices are a big part of that. And there are reasons for that the government are not tackling. It cannot be a sensible policy to charge people more for their mortgage until they stop buying food and lighting their home. Yet that is the policy. That is how insane a situation we are in. But there we are. Those are my thoughts. Let me know yours in the comments below. Hope you found the video interesting. If you did, please click the like button. If you'd like to support the channel further, the join button for memberships. And until next time, I'll see you later.